Welcome back. You're watching Storyboard and I'm Harit Nagpal, your guest editor. India's economic growth slumped to a two-year low of 6.9% in the September quarter, hit by a string of interest rate hikes, sliding rupee, etc., etc. As companies prepare themselves for a season of slowdown, will marketing budgets be pruned like they were in 2008? I asked Animesh Das to pick three very different companies to find out whether they are prepared to face the slowdown or will marketing budgets be pruned again like they were in 2008.
Things are slowing down for the Indian auto industry. For the first time in 7 years, the growth rate has fallen below 15%. The combination of rising raw material costs, high interest rates and weak consumer confidence has meant that the 33,000 crore rupee industry is now growing at 14.4%. Ford India, though, is bucking that trend. It has sold over 1 lakh cars between January and November, clocking a 31% sales growth over last year. That momentum is expected to help the automaker's marketing team not just defend its budget but also get a boost. As the company draws up its annual budgets for 2012, it says marketing spends will be strengthened. The aim to boost its Figo and Fiesta range.
Looking at all the data, both the long-term data we've used for through our brand funneling data has indicated a very strong growth right across all of the key elements there, and of course the short-term data that we use in terms of our dealer metrics, footfalls, etc., tremendous growth. And what it gets down to in the final analysis is our sales year over year. So this year we're up 30% despite a very tough environment, including exports. And last month we were up 11% year over year in a tough market. And they're the sorts of figures that eventually really tell the story about whether we're being successful with our marketing strategy.
Our key deliverables there are in terms of our brand positioning, creating enough interest to ensure that we have customers coming into the showrooms, and with our closing ratios achieving our retail objectives and overall demand. The interesting part about that part of it is we can fine-tune. We run our business against huge level of metrics.
Travel portal Cleartrip is on a similar path. The company earmarked 30% of its operating spends on marketing activities this year, and roughly 60% of that was spent online. Cleartrip says that though bookings for foreign trips have come down by 10 to 15% in the last couple of months thanks to the sharp fall in the rupee, domestic bookings are steady. So Cleartrip's marketing team can heave a sigh of relief. For now, the travel portal says its marketing budget will stay intact.
When you're spending on radio or print or TV, those things are harder to measure. And when they're harder to measure, they tend to get cut back. So that would be another possible way of doing it. But I think in today's day and age, I think Cleartrip is very well positioned to continue spending.
In times of a recession, I think a lot of people look at their largest variable costs, and marketing being one of them. I think we have to continuously look at our overall cost structure and making sure that's optimized. And marketing, and by virtue of being a large variable cost, is one that we look at. But having said that, I think it's important, especially in recessionary times, to make sure you invest in the business. And I think at Cleartrip we're focused on making sure we do that.
Driven by price hikes and volume growth, Marico's consumer business grew by 14% in the quarter ending September. However, while the top line seems strong, it doesn't quite reflect the operational challenges the company is facing, especially high input costs. As a result of the uncertainty, Marico cut its advertising and sales promotion spends from 13.2 to 11% of its sales and services budget this fiscal. While that translates to a cut of 6 crore rupees, Marico says it is not worried about any short-term impact.
There are spends which are important and there are spends which are critical. Now, as marketeers, we need to be very clear about what is critical for growing these brands, both in the short term and the long term. There's a tension within short term and long term. And what is the optimal point? Because there is business to be delivered and there's a brand need which needs to be taken care of. There's a share of voice piece which needs to be covered.
What we believe is smartly spending that money. So therefore, as I said, that if there are certain long-term bets or long-term innovations, something like that, we don't compromise on it. And if you really look at it, at the end of the day, when the environment is such that there is some kind of a because of the low growth in other sectors, also the fact that people are very choosy about spending. At the end of the day, you need to be looking at share of voice and not just absolute spends.
Stretching the marketing rupee and delivering high ROIs is the mantra for any marketer. But with the impending slowdown, this job will only get tougher. In Mumbai, Animesh Das.
If you look at what all those people said in that story, it doesn't look like marketing budgets are really going to be cut, or is that what you guys tell us when we come to ask you questions?
And rather, let's say these guys are being cautious. Because as the year has progressed, interest costs have been about 100 to 200 basis points over what we'd budgeted for. The dollar was budgeted for by us at about 46. It's been 51, 52 over the last quarter. Neither of these two costs are going away, going down in a hurry. Now, as the Q4 approaches and profit guidances have to be met, the only resort left in the absence of growing revenue, which can't grow in the current environment for sure, is to cut costs. Now, most costs in a corporate are kind of fixed or are linked to revenue. The only cost, a chunky cost that comes in my sight if I have to cut costs is marketing.
What would your tip be? Because you're the CEO and you've been a CMO and a very, very successful one at that. How do you defend your marketing budget? What do you do to ensure that you don't get such a big cut, even if cuts are made all around?
The only way I see is to create a direct linkage between marketing spends and revenue lines. So when the CEO is chopping any marketing spend, he's completely aware of the fact that he's foregoing some revenue either today or in the future. Now, in times like these, things like brand salience and share of voice, etc., are seen as luxuries and are likely to be considered as redundancies.
Excuse me if I sound like I don't know anything, but aren't they supposed to be aligned?
Well, a lot of people are supposed to be aligned, but they're normally not. So the CMO and the CEO have got to be aligned at the time of creating these budgets as to what these monies, each piece of this money
is expected
to deliver while you're running these budgets. And even when it comes to the cut, there has to be complete alignment, because very often when the cuts are made, it's the CMO who's crying and the CEO doesn't even feel any pain.
Okay. All right. So another story or a break? I can see that you're enjoying tossing to the break, Harit.
Well, there is time for another break. I need a breather too. So on the other side, we have notice board with 3 campaigns that I really, really like, and we have them lined up for you after this break.